I think we have now two very interesting perspectives here at our hands. When I look at Basel III, actually for me this is kind of a, how did Christine Lagarde describe it this morning? It's kind of a beacon. It's the most advanced piece of regulation that we have out there. It's actually quite interesting to see that the process of sausage making, as she was referring to this morning, has led to something that everybody finds quite tasteful, as I understand it. Nevertheless, I believe that regarding the headline of our panel, the impact, and maybe some of the technical elements, there may be some things to discuss as we are climbing that mountain. Maybe someone may say that we have already reached the top. I think we still have some way to go. I may now have three colleagues here who will join me in the discussion on the panel to discuss this. Let me start with Professor Hans-Helmut Kotz. He's actually the most difficult one to announce. He has a four-liner here that I need to read out to you. He's a senior fellow at the Center for Financial Studies at the Goethe University in Frankfurt here. And he's also a resident fellow at the Center of European Studies at Harvard University. And as many of you may know, he was also a member of the Bundesbank Directorium. As you can see, Gerhard Schick was also supposed to join us. For anyone who missed my little introduction earlier, he could not join us for the same reason that Gerhard Schäuble could not join us, because he was caught in the snowstorm in Berlin. We have Dr. Károly Szász joining us from the Hungarian Financial Supervisory Authority. And then finally, we have Frank Westhoff, member of the management board at die Z-Bank AG and its chief risk officer. So concerning Basel III and capital requirements, let's continue the tradition, as Mrs. Hengster was saying this morning, of having some yes-no questions to provoke some, hopefully, opposing responses. And let me maybe start by asking each one of you, is the proposed CRD4 capital and liquidity framework, as we have it on the table today, and it's drafted by the EU Commission, sufficient in your view to avoid future crisis? Hans-Helmut?
Jein.
Say no.
No?
No.
No. Hans-Helmut, you want to elaborate?
So it's a jein, a clear jein, because of course there were a number of issues addressed which were shaky in Basel II to begin with, which by the way was also completely disconnected from the academic debate at that time. So the first one is we now will have a higher level of capital, a higher quality of capital, which is really crucial in line of the argument which Andrew Chain also brought here, that you should allow for the capacity of banks going bust. In fact, famous economist Alan Meltzer once said, capitalism without insolvency is like Catholicism without sin. So it is most obvious that you wouldn't like to have a cushion to absorb shocks. And that largely refers to quality. Then a major flaw in Basel II, of course, was liquidity was barely existent. It was just in the part on operational risk. And one of those banks which went belly up early on in the crisis, somewhere in mid-September 2007, had a capital cushion of 13%, but had to refund its balance side, its liability side on a bi-daily basis. So there was a massive mismatch between maturity of assets and the average duration of liabilities. Third, I do think it's also important that we acknowledge that we do not know everything. So the leverage ratio is a very good constraint. So this is the yes part. But we know it doesn't suffice to have sound and safe banks at all. This has to come with many of the issues which have been not acknowledged also in Basel II, but now are somehow acknowledged in Basel III, which have to do with macroprudential. You have banks, have had banks running into massive trouble, being in full compliance with Basel II. That might also happen with Basel III. So we have to think about all those issues which have been touched upon here. I do think that's why it's important to think about one debate which is now very strong in academia, actually pushed out of Germany by Martin Hellwig, who actually says, why does Modigliani-Miller hold true for everybody but not for banks? Which is a very interesting idea, by the way, because lots of the financial engineering we do in banking is, of course, highly dependent. It's immediately dependent on that. So we have to think about why doesn't that hold true? But anyhow, I completely concur with those who said that we are now definitely going in the right direction. But by the way, there will be no rules and regulation which will prevent a crisis from happening again. No way. And lastly, last point. Beyond rules, it's of course important implementation of rules. An IMF paper has a beautiful title. It goes like this: what is most important in regulation? It's the capacity to say no. So enforcement is of the essence. Károly.
Well, I think you cannot expect regulation to be perfect. And you cannot expect that regulation can foresee a crisis and can prevent the crisis itself. I am of the opinion that you cannot expect regulation to be proactive. Regulation is always reactive. The question is how quick we are and how perfect we are in following and going after the developments and reducing the time span which elapses between the time of happening and the time of reaction. If regulation were perfect, then simply by means of regulation we could avoid the occurrence of the crisis, but simply it cannot happen. A market is always quicker, and we as regulators follow these market developments. So I think this is a very important theoretical issue, that regulation is very important, but is not a safeguard to prevent the occurrence of the crisis. Nevertheless, I agree with Professor Kotz that the current regulatory reforms contribute to a sounder, more robust, better performing, probably less riskier banking system, and as such they would probably better withstand a possible crisis. But simply we cannot avoid the crisis. The crisis is probably somewhere evolving and affecting us, and we have to be open in this direction, therefore.
Makes the mountain look much smaller now. Frank Westhoff, your perspective.
Well, I said no, due to 4 reasons. First of it is that, well, the new rules are more or less tend to be based on the past experience. Well, interestingly, Professor Kotz mentions the Modigliani-Miller theorem. Well, in the current circumstances, that predicts that there is a capital available without any caps, and that's not the case, at least for banks, not in the current circumstances. Secondly, the next crisis will have different causes and different consequences, and future crises will occur in spite of the agreed CRD4 proposal. However, at least we are somewhat a little bit better prepared now due to the increased capital quotes. I very like the remark of you, Mr. Tertak, concerning the reasons for the crises in the past. First of all, was capital. shortage of capital. Secondly, you mentioned the maturity transformation. I would like to add at least one, maybe two other ones. First is the asset quality. Asset quality is one main reason for failure of banks in the past. So, third point is, in general, Basel III is okay from our standpoint. I think it's a good solution, and as you said, it took time to develop all these rules, and by starting with the more general remarks of how we should go to put this in a real framework. However, the multitudes of ideas which are arising nowadays is a little bit too much, and I'm of the opinion it overburdens the system. Only a few remarks: Liikanen, financial transaction tax, the complexity of all these rules, the hundreds and thousands of pages where you have to stick to. To give you an example, the average earnings of the German banking system over the last, let's say 1995 till now, so 18 years, the average earnings per annum are roughly 8 billion per annum. And the estimated costs of the new regulation, the costs for capital, are equalizing this number, nearly 8 billion too. So where shall the capital come from, if not from earnings? Fourth point, there are some choice options in the new regulatory framework given to the national regulators by the CRR. And I'm of the opinion they should be used by the German regulator. Some examples from my own experience as a board member of a cooperative bank. There are some rules. First is the exemption of deduction of primary banks' equity participations above 10%. And the second is the exemption of intragroup participations regarding the large exposure rules. For us, it is very, very important that, that we get the allowance to choose this option, because otherwise we have very willing capital holders who are very eager to give us their capital, but they are not allowed to do due to regulatory rules. So all in all, I'm not of the opinion that currently the framework will avoid future crises. And one can ask if it is possible at all that there is any framework which will avoid future crises.
So if I can summarize, we're all quite positive about the goods of Basel III. Nevertheless, we feel that in addressing the question of financial stability, it's not enough. Maybe let's turn to the second headline of our panel, which is the question of growth and economic development. Does CRD4, in your view, strike the right balance between deleveraging banks' balance sheets, right? So the question of recapitalization, repairing the balance sheet, we've heard several times today, and also facilitating the need for economic growth in Europe. Mr. Westhoff, would you like to start with this?
Well, no.
No?
Short no.
I hope yes.
Jein.
Maybe we start with this side in explaining.
Well, one has to state that there is a different economic development in the European countries. In Germany, the risk of a credit loss for a bank is less an issue than, at least currently, for some southern states in Europe. In countries like Greece, Italy, Portugal, or Spain, there are serious economic problems weighing heavily on banks, on their capital and on their profitability. Well, the situation remains tense, not in Germany, but in some southern European companies. The economy is expecting to shrink, at least for 2013, and we will see what 2014 will bring us. Well, because of the current and the foreseeable losses, there will be a problem for southern European banks for some time. Moreover, in the startup phase of Basel III. Against this background and the high regulatory costs to be expected, it will be difficult for the banks to shoulder the necessary capital accumulation during the transition phase of Basel III. I'm of the opinion that the reform of banking regulation threatens to overburden the banking industry. especially in Southern Europe, maybe to a lesser degree in, let's say, in Finlandia or in Germany. And failing the required equity accumulation, the affected banks will have to restrict their lending business. If you have no capital, if you have no liquidity, you can't lend to your customers. Well, deleveraging and credit reduction is already taking place. That's not a theoretical idea. You can observe it in Southern Europe. There's a danger of an even more credit crunch that blocks the necessary investments for the economic recovery in these countries.
Károly.
So first of all, I have to admit that I have been not very long with the supervision, and I personally not involved in the different workshops that work or that have worked for the CRD4 issue. But me as a regulator or head of the Hungarian supervisor, I have to have confidence in my, let's say, fellow colleagues that when the structure has been built up, although the primary aim was to achieve, or is to achieve a sound and sustainable financial intermediary system, nevertheless, the consequences, though secondary, but have been taken into consideration. Secondly, I have to differentiate between the shorter and, let's say, longer term impact. Maybe on the shorter term, these regulatory changes will increase the cost of banking, the cost of financing, and probably this could contribute to some deleverage. Nevertheless, on the longer term, we will definitely reach a better performing financial intermediary system, which probably will prove that it will serve the costs and the benefits will exceed these costs. Thirdly, I am not sure whether those consequences which we are talking about, namely the deleveraging effects or the, let's say, slowing down of the economic growth, are really consequences of the regulatory changes, or they would not have occurred anyway without the regulatory structural changes. Let me tell you that we in Hungary, for example, conducted studies in which we checked whether these changes, also including the different government measures imposed on Hungarian banks, really resulted in a declining appetite of the banks for performing their banking business or not. We just wanted to see whether the ability of the system, so on the supply side, shrinked or not. The deleveraging could have occurred from the other way around, whereby simply the current recession, the economic and financial crisis, resulted in a lower credit demand of the corporates, whereby there is a shrinking financial activity of the banks. And the final conclusion of this study is that approximately equally 50% can be explained by the modified or lower ability of the bank, the higher risk awareness in, let's say, contracting to lending, and exactly the same percentage can be accounted for explaining that there is a lower credit demand of the corporates. So I think that sometimes when regulatory changes have to be made, you have to take into consideration, of course, the major aim, which is to make a more robust system, of course, deal with the consequences, but they are only secondary thereto. And even these consequences are not entirely attributable to these changes, and therefore I say that probably that is the right balance.
Hans-Helmut, you seem to be undecided.
I start with my friend Elemer's remark, which is, it's always the same. Always the same means massive over-leverage. That's the starting point. This massive over-leverage means, to put it that way, there's too many out who do not obey their intertemporal budget constraint. Too much debt. Too much debt, almost as a logical corollary, means, well, too much finance. And the natural outcome of that is lower level of banking activity. In fact, that's what we see. The balance sheets going down, employment going down. This is the macro picture, which is relevant for those who are writing the regulation. They don't take the micro view, which was very nicely portrayed by Mr. Westhoff. So, but there's an easy fallacy of composition. You cannot optimize the system by taking a micro view. So we for sure are up for a new finance environment. And this finance environment will mean that the idea of return on equity beyond, I don't know the number, I've forgotten it. It was always hilarious, but this is done. This is gone. So Detlef. So this is the background against which what we actually care about, what regulators actually care about, is access to funds at an appropriate risk-based price. So will user cost of funds increase as a result of those regulations? That's what you're actually asking, Thomas. And that's pretty much an empirical issue. So there was a macroeconomic assessment group by the Basel Committee. They used 72 models, all sorts of models, fancy, dynamic, stochastic, generally equilibrium models with money, frictions. And the upshot of this research was there might be an impact on growth of minus 0.2 percentage points. So when economists talk about cost, they think about opportunity cost. I immediately accept 0.2 against the massive opportunity cost which was inflicted upon the system by a completely misregulated financial system. In fact, many of those countries we are still speaking of, they not only have lost a decade, they are falling two decades behind. Those are the costs. The reason for the substantial conservativeness of regulators is not that they are mischievous civil servants out of Brussels, some of them are. But the reason is that they would like to prevent the taxpayer from picking up the next big bill. And those 0.2, which come out of I do think, very reliable, completely eclectic, very reliable research, would be costs which, on my book, I would immediately accept if I would see the alternative. Let's make it clear, and then I stop with two numbers. The UK started into the crisis in 2007 with a debt over GDP, gross debt over GDP of 47. It's now in the lower 90s. The US started with lower 60s. It's now above 100, now completely unsustainable track. So that's what's the target to be achieved, not to let something like that happen again. And that comes with a little bit of pain. Sorry for that.
Well, I would like to take over at this point in time. You mentioned the taxpayer. Well, that's a good word, because if you compare this whole regulatory framework with taxes, for example, it's equal to, let's say, doubling the tax base on one hand, and on the other hand, tripling the tax rate at the same point in time. So that was what I meant with overburdens a little bit. Not for every bank, not in every country, but in general. It's a question of prudent sense how to go on with regulations. I'm not against this, don't misunderstand me. I'm only against the multitude of ideas at the same point in time.
So I was a little bit wearing my old hat. You know why? Because you do not serve any purpose if you just complain. if you would like to move this towards a direction which is sensible, which I do think is really important, then you'd have to take the objectives of those Brussels people seriously and be constructive. Just saying this is overburdening us, that doesn't tell me too much. And I was referring now to really very sober research, and that's why I alluded to it. It's 72 models. So it's not one person, it's using all sorts of perspectives on how that could pan out. And most importantly, it has been acknowledged from regulators to a substantial degree why academics are strongly against it. There's so much leeway before you introduce it. So it will not be, wasn't introduced in 2010, 2011. It's 2018, 2019, and so forth. So that should give some time to adapt.
Maybe let's explore a little bit the macro and the micro that you were referring to. Here's one question at the macro level, and it escapes maybe a little bit the model word that was employed, because I also looked a little bit into that at the time when I was in Brussels myself. So because it basically leads itself to the question of, you have a deposit gathering function in a bank and you have the lending side. Now, with putting more constraints on the balance sheets, one may argue that there has to be a substitute somewhere, right? So it's either shadow banking, as Christine Lagarde was saying this morning, or we basically rely more on capital markets. So what is your perspective? Will this actually increase the real economy's dependencies on capital markets, which we somewhat seem to be afraid of with all this regulation on capital markets? Or will it actually provide a safer banking system that can hold its competitiveness against the capital markets? I don't know, who wants to take the first vote? Yeah, go ahead.
So I completely agree with what Madame Lagarde and others said, which goes like this. If it's a duck, if it's flying like a duck, if it's walking like a duck, if it's eating like a duck, it's a duck. Treat it equally. So do not do regulations from an institutional perspective, but functionally. Because if you don't, you open up loopholes. And that's probably a big flaw of what we're now doing. So we're letting perform the same activity under different regulatory constraints, which has a very natural consequence. So we should organize regulation in a functional perspective, which would not lead to what you were referring to. On the other hand, there will be an increased role for internally generated funds. There will be an increased role for capital markets. But there will also be a strong relationship role for banks, in particular for those small and medium-sized companies, which are mainly bank-reliant. Yes, of course.
Károly.
Well, I think that the stricter regulatory changes will shift dependence on shadow banking and also on capital market activities. Nevertheless, Central Eastern Europe, so my country, my region, is traditionally a banking-based market. So we don't have a very sophisticated and developed capital market. Companies usually do not find themselves on capital markets. So therefore, I cannot really foresee what will happen. So there will be probably a driving force towards these markets, but as long as they are not able to emerge or develop and function, the banking market will still remain the major player of transmission of risks and maturities. Nevertheless, at a little bit higher cost, little bit higher, let's say, collaterals with more risk awareness, and therefore affecting especially those players of the market, meaning the small and medium-sized companies who by far don't have too much access to other markets than the banking market.
A little bit confused. So we are saying that actually it's not a big impediment to growth, but nevertheless we say, capital market access and shadow banking will increase, and it's kind of important. That maybe you can dissolve that a little bit for me.
Well, this is a question for disintermediation. 1 or 2 months ago, there was a survey of the ECB about the latest improvement, the funding situations of banks, and the outcome was that there was no expansion of credit supply instead of the improvement of the funding situation, but more deleveraging in 2012 at least. So the credit volume decreased, the lending conditions were tightened, especially for riskier borrowers. Well, for larger enterprises, it is much more easier, to enter the capital markets and to tackle with the situation than for SMEs. However, these effects for disintermediations are difficult to forecast, in my opinion. It could increase the overall risk because the bonds are more likely subject to a contagion in the case of a financial crisis. And it will make risk diversification more difficult for banks because the bigger corporates go to the capital markets. Well, in this context, please allow me a short commercial. As you know, I'm a delegate for the cooperative network. And in contrast to the general trend for the time from 2007 to 2012 was an industry average of loan growth of 1.7. Not average, the total loan growth was 1.7%. The German cooperative financial network, which serves more the small and medium-sized enterprises, increased their loan volume by 19%, more than 10 times as much as the rest of the industry.
So we have the growth case.
We have the growth case. Yes.
Good. Let's turn to the micro. Do you believe the banking industry and the regulators are sufficiently equipped to address the technical complexities of CRD4? Maybe starting from your end.
Well, all of us, we have the same common goal. The regulators, the politicians, and the financial industry. We have a common goal. We want to have a stable financial industry which serves the real economy and society in general, and we want to restore trust that we have lost in recent years. And again, there's a multitude of good ideas how to regulate and how to measure the risk, to regulate in an incredible amount of detail. Aggregating many good ideas, however, does not necessarily lead to a good overall concept. I'm very much advocating for looking on the business model of banks, on the management of banks, not in every the hundredth detail of some mathematic models that don't help us and that don't prevent from crises. It certainly does lead to complexity and contradictions, though. And getting even more sophisticated in the mathematical details, it is easy to stray far off the actual underlying real risks. That's my opinion on this.
Károly, the regulatory view.
I have to admit that I would never dare to pretend that we as regulators are much ahead than market players. And I am not able to say that we understand and we are expert in the complexity of these issues in evaluating models. But I don't believe that this is a precondition of effective supervision. My opinion is that if we have an open, let's say, approach, a mutually open approach, whereby we both learn from each other and we analyze the issue together in a cooperative manner, then we can reach our common goals. And this is not only true for banking, but also for insurance business, where similarly very complicated models will be developed under Solvency II. And I understood that this is a process in which probably something starts now on the insurance industry, which has already reached a certain level in the banking side. And I see from my colleagues that there are permanent meetings with companies in colleges, and we try to learn, and learning by doing. This is, I think, the expression how we will solve this issue.
There's for sure many very competent and diligent examiners and supervisory authorities, and they of course do know the models. They've written books on that, thousands of pages. So I don't doubt their capacity to be as good as private sector risk managers. But we should be a little bit more humble in terms of thinking about what you were actually alluding to, the complexity of all those models. In fact, none of them is really robust and reliable. So we have to be careful in terms of applying those models. Now, if you see, which you always see in those quantitative impact studies, that identical positions are evaluated very differently depending on which bank internal model you use, you get humble. By the way, you're not humbled by the math of this stuff, which is not utterly, which is often too simplistic. But that leads you to the point that you would like to have supervisors who have guts. Supervisors who are capable of saying, they have to be more intrusive. And Károly, this is about implementation. This is about, there were supervisors, by the way, who had guts in terms of going against the currents, though they are now representing an economy which is not doing that nicely. But for example, the Spanish supervisors never accepted structured credit products below the balance sheet, although they were strongly criticized for that. Actually, they came up with a macroprudential tool, which we now call, used to be called dynamic, no, they called it statistical provisioning, Helmut. They just used the very simplistic. So there are people who had guts, and there's too much 20/20 hindsight. So I would like that we would be much more encouraging supervisors to invest themselves into this. By the way, it might be much more intrusive for banks than fumbling around with capital requirements. But I do think we need more authority in a very traditional German understanding of the word on the side of supervisors.
Károly, you want to add something?
Yes, I just would like to say that I won't like to shift the responsibility only on one side. So I admit that if something is too complicated, which cannot be understood, then we should not accept it. And me personally, have the obligation to ask until we understand. But this is true also for the other way around. That if the market develops a product which is very, very complicated, and even the client doesn't understand it but invests in that product, that's a very big mistake. So clients also should answer and understand the risk. And also this is true for the banking officials, who sometimes sell products without knowing and understanding the essential structures of these products. So therefore I said that we have to be open and we have to dare to ask questions as long as we understand something which we have to supervise.
Well, I think that's very key what you said. Banks should think more about what is in this product for my client, not what is in this product for myself.
Yes.
With this, I would like to open the floor for questions.
My name is Alexander Mettenhammer. I'm chairing the risk committee for Bayern LB. I have a question for you, Professor Kotz. At what level of return will a rational equity investor stop investing into banks? And I have a question for Dr. Szász. The Hungarian government levied a banking tax 6 times higher than the average of the European community. And I was wondering whether you could share with it how much was collected and how it is used in the resolution or rescue fund for banks.
There's, for example, work for the US, which shows that return on equity for investment banks over the long haul, so that you would take care that you do not have a small sample bias and that you have sufficient significant numbers of banks. Investment banks used to produce a return on equity of about 11%. This comes with a substantially higher variation than it is the case for commercial banks, which are at about 9, standard deviation of about 2. So basically, if you go at return on equity, by the way, is a number you wouldn't look at. You would always divide, because it's not risk adjusted, you would always divide ROE into standard deviation. So you basically end up, which you should, in equilibrium at almost the same level, accounting for the risks. This has been done by for a long series of data by New York Fed economists. We also have, meanwhile, studies for the OECD region. So this is what you would expect coming out of a typical CAPM model also. It would be in line with the nominal growth rate of an economy which you're serving, plus a decent risk premium on that. So substantially below that, what we had for a number of years, which, by the way, is talking about the mean. So, of course, you can, around this mean, in a panel of institutions, have a number of institutions which, for even a while, would have higher return on equities, but that's not the mean. I was giving you the number which is generated by markets. This is just facts. And investors probably should know what the facts are. There's an academic literature on all of this, which is under the heading of irrational optimism, which shows that the expectation of returns are substantially above what the economy is capable to deliver. And that's what the facts are. So I don't put a judgment on that. I just tell you the numbers. That's just
Károly.
Positive economics.
Question on Hungary.
So first
Detlef
of
Harmsdorf, Deutsche Bank.
no, sorry,
Well,
let's-
we have the
yes.
question on Hungary first.
On the banking tax issue. So first of all, I would like to say that the Hungarian government really decided to follow its own way in tackling the financial and economic crisis in my country. And some measures were, let's say, referred to be as unorthodox. But, and this is very important to understand, they served the interest of the country, whereby Hungary is no longer at the edge of the cliffs. Hungary's situation was very much alike that of Greece, but Hungary's budget is now balanced and under 3% deficit. So it is an effective measure, and please try to understand that these measures are also effective and, let's say, aimed at the right direction, and probably the future will explain whether they were right or not. My second remark is that although these banking taxes are really very high, but unfortunately the banks, and especially those coming from Western Europe, introduced the foreign exchange lending in my country, which resulted in a tremendous economic and social problem, which had to be somehow tackled. The losses of the banking sector, which are the consequence of provisioning loans having past due due more than 90 days are more than 3 times as much as what the banking industry had to pay for the banking taxes. So in my personal, let's say, interpretation, how I approach this issue is or was that the banking industry, through the taxation system, contributed indirectly to the crisis management and to the budgetary issues of the country, and through their provisioning mechanism directly because of the direct losses which they realized in their balance sheet. My third remark to this is that, of course, some of these taxes were rechanneled back to the industry because in 2011 and 12, when the foreign exchange debt of the households were allowed to be prepaid at a lower exchange rate level, then 1/3 of the losses of the banking industry was recovered from these taxes. And as far as the future is concerned, there are intentions now along which the Banking Association and the government works, whereby further portions will be returned to the banking industry, provided that there is a common understanding how to finance small and medium-sized companies and how to finance more the local economy. Sorry.
Detlef Harmsdorf, Deutsche Bank. Can I refer again to this very interesting return on equity question? We had in former times discussions on that, Professor Kotz and myself, so I can repeat a little bit on that. But definitely what I think I got the name right, Mr. Mettenheimer has asked is absolutely correct. I mean, you wouldn't believe me, but even banks have to compete for capital. And not only between banks, but with other sectors of the economy. And of course, if you don't have a sufficient return on equity, we can't get any capital. That's very easy. 11%, yeah, well, that's a figure we can use after tax, I hope. After tax, if it's before tax, then we can give up our business in the end. It's very clear that, for example, the manufacturing sector, I have only the figures until this famous discussion of 25% until the crisis, but definitely 20 years ago, the manufacturing sector had far ahead of 25%, 30, 32% return on equity. I mean, that doesn't mean that banks must have that, but at least we should be competitive as regards capital acquisition. That's very easy.
Okay. Mr. Westhoff, you want to comment on the indeed very prevailing question of competitiveness in access to capital markets?
Well, we are not stock listed, so we do not have to convince shareholders with 25% return on equity or whatever it is. Well, we are as a central institutions for our primary cooperative banks. We have 17 million of members, and what do they want from us? They want good services, and we, as a central corporation for the cooperative sector, we have to deliver good products, we have to deliver liquidity, and so on. If we do this right, they will give us capital. It's not a question of how much percentage we put on the coupon. It's more a question, are they allowed to give us capital? So that's for us of, well, I won't say minor importance, it wouldn't describe it right, but for us 10, 15, 20, whatever it is, percent, it's not important. It is important that they are allowed to give us a capital. The cooperative network is very capital rich, roughly 70 billion in capital for the total group. The question is only how to divide this between the several pillars of our network.
So there's no doubt, there's no doubt Detlef Ramstorff is right. Each and any company has to, at a minimum, earn its cost of capital. No doubt about that. And of course, everybody should be ambitious. Why 25? Why not 50? It's not about that. It's about taking data seriously. Taking data seriously, which means, in simple statistics, to take a broad group of institutions over an extended period of time. So that, to go into technicalities, it is about panel data analysis. And what comes out of this research is, the numbers I gave you, after tax, as you probably know. So this is what investors do have to acknowledge. The underlying economy growing, so I'm now telling you just Cap M. Cap M goes like this. It's risk-free rate plus beta times difference between expected return and market return. So if you use this number and plug what you have as an underlying growth in the German economy, add a decent risk premium to that, plus a beta, which is in the case of a well-diversified universal bank, what? No, one. So then you are below what the numbers I said. You know, for reasons of risk that it could be slightly higher, but it cannot be double this or 3 times this, and it cannot be this for the whole industry. That's just one of the most interesting fallacies of composition.
Looking a little bit at the time, whilst I would love to explore the question of market values. We have this final tradition of completing sentences. And obviously I want to conclude with that as well. Maybe Hans-Helmut, starting from your end. Regarding the discussion about new capital requirements, I feel banks, policymakers and regulators should focus more on
getting really on a common constructive ground.
For me, to work more on home and host cooperation.
Applying new regulatory rules with diligence and good human sense for proportion.
This I would like to conclude. Thanks a lot for your time. And thanks a lot to the panelists.